Hello, everybody. Welcome back to Market Making Insights with Meenu Sarin. I'm the host and the moderator. So who will be hosting Meenu Sarin as she's going to be coming on the show and speaking about market making. So this is a series of episodes that we started a couple of days back. So the reason we started this is because with the increasing acceptance of cryptocurrencies as a viable and safe financial asset, the rapidly growing number of crypto exchanges around the world, market making in the crypto space has become increasingly common. Yet, I would say, even though it's common, yet it's still largely unexplored. Market makers, because obviously I'm a part of a cryptocurrency exchange. Market makers and cryptocurrency exchange play an important role in increasing the accessibility and the liquidity of cryptocurrencies to traders. So traders are the heart, the soul of a cryptocurrency exchange, and the investors as well who invest into these tokens, and the market participants. Obviously there are other people who are a part of the ecosystem as well around the world. So we started this series with basics of market making. So what is it? I mean, just a recap. Market making is an activity where a trader simultaneously provides liquidity to both buyers and sellers in a financial market. Liquidity is the degree to which an asset, in this case a digital asset, can be quickly bought or sold without affecting the stability of its price. And some of the benefits that we have covered in the past episodes includes increases the market liquidity and the order book depth, reduces price volatility because cryptos are very volatile by nature, assists with fair price discovery of the token, more efficient bid-ask spreads in cryptocurrency exchange order books is very important, more orderly entry and exit points for traders, and dramatically reduces slippage, helps accommodate large institutional investors, and so on and so forth. So, today in this episode, we are going to, when we started this off, we started the basics, slowly moving into a more in depth. Into the market making liquidity market. So today what are we going to talk about? Today we're going to talk about impermanent loss. For those who those who are not probably not in the space, is something so new, because this applies to decentralized platforms. So what are decentralized platforms? DeFi protocols, which are very popular, like Uniswap is one of the most popular name that pops up when you talk about decentralized protocol. Then we have Swap. There were Pancake Swap. So they have seen an explosion of volume and liquidity. So these liquidity protocols enable essentially anyone with funds to become a market maker and earn trading fees. So democratizing market making has enabled a lot of frictionless economic activity in the crypto space. So today we're going to discuss about impermanent loss, talk about liquidity provider tokens, which are LP tokens, liquidity mining, and yield farming. So I'm going to introduce and bring my guest speaker, Meenu Sarin, on the screen right now. Hi, Meenu. Hi,
Hi,
welcome
hi,
back.
Sunny. Thank you. Thank you for the welcome back.
How are you?
I'm doing good. What about you?
I'm great. I'm great. Had obviously a very busy day, but that's
Hmm.
about it. I mean, you can constantly on the go, talking to projects and everything. And every time I hear liquidity, I remember to tell them to watch my show with Meenu Sarin.
That's a good one.
So yes, yes, yes. I send the links out. So they obviously it's a lot to take back from your shows, from yourself. So Meenu Sarin, Meenu, let's have a quick round of introduction. I'm going to zoom out on you now, so that people know, like, what Meenu Sarin is all about, and why are we doing this series of episodes, and your interest into the field. Over to
Okay,
you, Meenu.
sure. Thank you, Sunny. Thanks for this opportunity. So, I'm basically a technology evangelist, and there are a couple of main services that I offer through my company, VLSI Consultancy. And that is number one is to kind of go in for the qualitative analysis, the research and analysis of technology markets and the technology trends. And the second one is on the evangelism, the technology evangelism, and the community build up, the ecosystem build up. So, those are the two main things that I work on. And I span a few domains, and these include things like semiconductors, blockchain, robotics, and deep learning. So that's quite a wide thing, but that's how my career has traversed over a period of time. And as far as the blockchain is concerned, I also do have a podcast which is called the Blockchain Hustle Podcast. You can find it on the YouTube by this title, which is also under my tag, which is Blockchain Hustle Podcast. And I've been podcasting for the last 1.5 years, and my major theme in this was to kind of explain various basic concepts and then take some kind of a real industry, real life example to kind of connect the two. And once I had done a few episodes on that, a friend had asked me about the relevance of blockchain in the public sector. So, what started as a white paper for her turned out to be a 14 episode series, which was blockchain in the public sector. So, I talked about governance and what people are doing, what properties of blockchain helps, and stuff like that. And then the pandemic happened. And I took that opportunity to talk about how blockchain impacts the new norm. So I had another series, which is blockchain in the new norm. Now, while I was doing all these podcasts, there was something which was there at the back of my mind, which was more related to the markets. And which was how do these guys, the stakeholders in the blockchain and the token ecosystem, to be more precise, how do they get the money? And I knew I would not be able to do it if I do not understand the market economics. So that started my tokenomics series. And from there, I started delving into it and I started sharing my learnings across my platform, that is the podcast. And that's where LA Token Sunny came to me and approached me and said, "Would you be keen to do this market making series?" And I kind of jumped at the opportunity because I do believe a lot in evangelism. So yeah, so this is about the podcast thing, and my foray into blockchain started with a hybrid blockchain startup, a company called Zinfin, which Zinfin came up with a very innovative hybrid blockchain system, and it is targeted for the trade finance ecosystem. But we see a lot of other applications, the apps being built on it, and I'm
Right.
happy to see that it is growing. And I was working to help in their community build up the ecosystem build up. So that's my introduction as far as the uh, blockchain and this particular market making thing is concerned.
Fantastic. Thank you so much, Minu. And I really, honestly, from the core of my heart, thank you for, sort of giving your time to this platform and bringing that wealth of knowledge to this platform. I really, really thank you and appreciate your time on this platform. So
Thank you.
today, as I remember, we sort of discussed last episode, last Wednesday, that we're going to touch upon certain sort of drill down into particular topics of about like liquidity mining, LP tokens. I think we couldn't cover another important topic about impermanent loss as well. We are supposed to cover it last episode, but we sort of ran out of time. So
Yeah.
yeah, so which one would you like to start with?
Okay. Just a very, I know you did give a very wonderful and detailed introduction on the topics and liquidity in the markets, etc. But just a quick recap on the episodes that we have covered till now. So, in the first episode for our viewers, in the first episode, we spoke about efficient markets and the requirement or the need, importance of liquidity. And then we followed it up with the market maker's role. That is, what do they do and how do they inject liquidity into the market? And then we followed it up with the automated market makers, the liquidity pool. And so that impermanent loss was the stuff that I could not cover.
Right.
And I'm going to start with that. So if you can just put my first slide of today's session on, Sunny.
Yes, so I'm going to share my screen and I've got the, let me just share my screen, share my screen. Okay, I hope uh, am I on the slide
Yeah,
now?
you are. Yeah, yeah.
Okay, cool.
So this is going to be also a kind of a check how attentive, Sunny, you were in the last episode,
Oh my
as well
God, you
as
testing me. Me too. I'm nervous now.
I'm just kidding. And also
Okay,
the viewers who were there in the previous episode and who are there too in this one.
right.
So in the previous episode, we covered about the liquidity pool. And so in this particular one, what I do have is something called it's one of the risks of liquidity pool, and it is called the impermanent loss. So if you recollect, we started with a liquidity pool which has got 10 ether and 1,000 DAI. Or let me
Yeah,
just check my, because it's a little, yeah. 10 ether and 10,000 DAI.
we still have
So
that.
in
Yeah.
a liquidity pool, you need to have a token pair and the value has to be the same. So here, when we took this example, we said that let's say the price of ether is $1,000.
Yeah.
So 10 into $1,000 should be equal to 10,000 DAI, which is again the $10,000. So you need an equal value of the token pair in the liquidity pool.
Yeah.
That's by definition. So let's say we have this liquidity pool to start with,
Yeah.
and you have an investor, Anna. And before this, let me just start with that. There was this. I've extracted this example from one of the articles in Medium, and it was written by the Juan SC,
Hmm.
and it's titled "We Need to Talk About Liquidity Pools in DeFi." And I
Okay.
found it to be a very well articulated and a very informative article. So I would highly recommend you to take it,
Right.
read it. But
Okay.
let me just go through this example of that impermanent loss. So let's say you have a depositor, Anna,
Yeah.
and Anna she makes a deposit of one ether and 1,000 DAI,
Hmm.
and she puts it into this liquidity pool. Okay.
Yeah.
And now this liquidity pool has got 10 ether and 10,000 DAI.
Yeah.
So, what is Anna's share in terms of the fiat currency, in terms of the dollars? So, one ether we said is $1,000, $1,000 plus 1,000 DAI, which is another $1,000. Anna's share is $2,000 in this pool.
Yeah.
And if we talk about a percentage, it is 10% of this liquidity pool. So one ether is 10% of your 10 ether, right? So
Yeah.
she has got a 10% stake in this liquidity pool. That's
Yeah.
where we're starting from. Okay.
Yeah.
Now, if you recollect in the previous episode, we spoke about what happens if the price of ether changes to $4,000.
Yeah.
So if you recollect, we were talking about how does the liquidity pool kind of change its
Yeah.
constituents, number of ether and DAI in our case. How does it change to reflect the global market price?
Yeah.
Because if it does not change, what happens is that it opens the door to the arbitrage traders.
Yes.
So the
Correct.
arbitrage guys, they will see, hey, the ether here is cheap. It is $1,000, whereas outside it is 4,000. So what they're going to do is they're going to take the ether from here and then they're going to sell it in the
Sell.
place where it's 4,000, right?
Yes.
So
Yes.
that thing will keep happening till the pool comes to a consistency of price of the number of tokens by when where it would reflect the new price, the market price of ether.
Yeah.
So as we had done our calculations and maths last time,
Yeah.
the new liquidity pool, the updated pool would now have 5 ethers and it would have 20,000 DAI.
Hmm.
Okay.
Yeah.
So remember, Anna's share is 10% of the pool,
Yeah.
which
2
means
2000
that,
bucks.
yeah, exactly. So if she were to redeem her 10% share, she can redeem it anytime, depending upon the liquidity pool's terms and conditions. She will get the same share, that is 10% share of the value of the pool at the time of redemption.
Right.
Okay.
Yeah.
So what is her 10% equal to now? So if I say her 10% share, it's now zero point 0.5 ether and 2000 DAI, right, of the new
Hmm.
pool, it
Okay.
turns out to be $4,000. So that
Okay.
is in the next slide.
Right.
Okay.
Yeah. Is
Yeah.
it the second one?
Yeah, this is the second one because I have my slides on the side here. Okay.
Okay.
So you see that now her share, if she has redeemed it, comes out to be $4,000. So starting with 2000 and now she's got 4000. She has got a $2,000 profit when
Hmm.
Ether has moved from 1000 to 4000.
Right.
That's very good. But let's say now you get on to the third slide.
Yeah.
Sunny. But let's say if she had not put her money into the liquidity pool, what if she had kept her money, her assets in her crypto wallet? So what she had kept in her crypto wallet is, let us say, her initial share, which is one ether and 1000 DAI.
Hmm.
Going by the current price of ether, that turns out to be 4000 plus 1000, which is $5,000,
Yeah.
right?
Yep.
So in her wallet now she has a profit of 4000 bucks, and in
Yes.
the liquidity 5000, 5000 and 2000, $3000 profit.
Yeah.
Whereas when she redeems it from the liquidity pool, she has a $2,000 profit.
Right.
3,000 and 2,000.
Hmm.
So this loss, notional loss or whatever loss that you call it, is called your impermanent loss.
Impermanent loss. Okay.
Yeah. So when people are putting their money into the liquidity pools, they would kind of see how and where the potential things would happen.
Hmm.
Now, if as a liquidity pool owner, for example, I would need to incentivize my depositors. Hey, come contribute to the liquidity of my pool. Okay. By just putting in the liquidity, nobody would come because they could have a loss, right?
Yeah. Yeah.
So, how do you incentivize the liquidity providers to come and contribute to your liquidity? And that is where I got this theme of today's episode as making your liquidity work harder. So, in
Right.
this, I would say that what are some of the avenues by which these depositors, these liquidity providers, what are these some of the avenues by which they can get a higher return of the funds that they have put in, higher return
Right.
of the assets? Okay,
Yeah.
so let's get on to the next slide,
So if
Sunny.
I understand correctly, so this what I
Impermanent
understand,
loss.
impermanent loss happens when the price of the assets in the pool changes, right?
Yeah. No, actually, what happens is whenever the crypto token price changes,
Yes. Yeah.
which it would, right? And it
Yeah.
would, it's pretty
Yeah.
volatile also. So
Volatile. Yes.
you have to take a punt or whatever you call it as an educated guess as to what do I need to do. So whenever the price of the token changes, the liquidity pool reconfigures to a different number, but it has to have the
Mm.
same value of the token
Yes.
pair. But the
Yes.
quantity of the tokens in the token pair changes to reflect this new price of that
Yeah.
crypto token.
Absolutely.
So whenever that changes, if I redeem it, or if I had not put my money into the pool at all, if I had just kept my money, my funds rather, into my wallet, what
Hmm.
would the difference be? If there is a loss, that's the one that I showed right
Yeah.
now, that
Yeah.
is called an impermanent loss.
Impermanent loss. Got it.
Okay.
Right. And it's associated with DeFi platforms and automated market makers, right?
I would put it across as that it is associated with the volatility of the token.
Okay.
So the thing would be my take on this would be that it is similar to you have the thing choice, or let's say the option of having different financial instruments, right?
Hmm.
Now you may say that I put my money onto one financial instrument and not in another. What if
Hmm.
I do not put my money at all? Let's say if I put my money in an equity, for example, the
Yeah.
price of the equity goes high, I get a profit, I'm happy. Let's say, suppose the equity, the share just tanks. I would say, hey, I do not get much of an interest in my bank deposit, but still I would not have lost my money, right? So
Yeah.
I would not specifically say it as the liquidity pool or AMMs or something, but
Right.
this is an
Okay.
example of the
Hmm.
loss in a liquidity pool.
Right.
Okay.
Okay. Got it. So we have our next slide, which is make your
Yeah.
liquidity work harder, as you rightly said. And we are covering three topics: liquidity
Yeah.
mining, liquidity token, and yield farming, right?
Yeah, that's correct. So let's start with the liquidity mining. Now, in the liquidity mining, what happens is that, as I said, we need to, no, you just keep that slide,
Okay.
Sunny.
Yeah.
Yeah, thanks. So you need to incentivize your depositors, the liquidity providers. So one of the ways that you can incentivize them is that you can give them some sort of a dividend.
Hmm.
For example, you say that for every transaction that happens using your liquidity, every transaction that happens on the blockchain, I will give you X percentage of that. So, which means that whenever a transaction happens, block gets created, new tokens are minted, then these liquidity providers, they will get some percentage of that newly minted tokens. That's one of the ways by which you can incentivize them.
Right.
Then you could also say that I can reward you with the governance tokens of my protocol. Okay. So taking this, what I put it as the trading fees. So for every transaction, I'm getting some percentage of the tokens plus some kind of an interest for me to put or to stake my liquidity with you. These would be some of the examples of uh, getting a little bit more on your liquidity. And this process is called liquidity mining.
Right. So, Minu, sorry to interrupt. I've got a token owner. Just quickly, he's going to touch base on this liquidity mining because he's planning
Sure.
to come on La Token soon from the decentralized platform.
Okay.
So, hi, Dusko. How are you?
He's
You are on mute. You're on mute.
Sorry about that. Hi, yeah, I said I'm doing very well. Thank you very much for having me on. As
Just a
you
quick
rightly, yeah,
intro.
yeah. Go ahead.
No, just a quick intro about yourself because I
Sure,
just spoke to
sure.
you about the show and we're talking
Yeah,
about
sure.
liquidity mining. So, yeah.
Yeah. So I'm the CEO of a project that I started with my co-founders back in June. So it's been less than 2 months since we started. It's going to be 2 months on the 20th now. Its project is called a Lunarland. It's our take essentially on a rewards token. It's a fully decentralized concept, so we're a community owned. There's no legal entity structure behind it, and that's been done that way on purpose. So we're a token that offers essentially low slippage, no tax trading. But we also have a spin on the reward side of things because a lot of these tokens that do offer reflections or rewards to their community, as they say, reflections, they put a high price on those reflections by having to pay a tax when you buy and a tax when you sell. And my background is in traditional finance, so I know a lot about slippage outside of crypto. And we wanted to create a more fairer system where you don't have any of that. You don't have any payments for those rewards, but you still get the rewards for being a long-term holder. So that's really what Lunarland is about.
Right. So, where are your tokens currently traded on?
So we've listed on PancakeSwap. We listed on the 21st of July, so just under a month ago. And we've been doing really well. I mean, obviously, yes, we provided the initial liquidity pool, and you talked about impermanent loss, and that's something that we're going to have to face. There's really no way around that with the current way that the automatic market makers are structured. Unless you do it in a currency pair that's obviously a stable currency, like a BUSD or something like that.
Yeah.
Yeah, so we launched on the 21st. We had a pre-sale for 2 weeks, so we moved fairly quickly to try to get on an exchange, and we've done really well. We're now at 11 times our pre-sale price, so the growth has been phenomenal.
Yeah. And you're also planning to come into a centralized exchange, right?
We're looking at a centralized exchange. La Token is one of them. We're obviously in discussions with you guys. We're looking at decentralized exchanges as part of the reason that there's a limitation, fundamental limitation in the way that decentralized exchanges work, and that's obviously the necessity to provide the liquidity pool, to the AMM engine that's behind them. Sorry, my family's in the background. I've got a little one.
No, it's okay.
My wife and my little ones. So basically, yeah. So the drawback with unless you have high slippage, and part of the reason why a lot of tokens, I don't know if that's common knowledge or not, but it really should be. I know a lot of investors are not aware of it, but part of the reason why a lot of tokens that come on centralized exchanges put high tax rates and high slippage is because that's one of the ways to shore up your liquidity exponentially by taking from the investor at every trade and putting a percentage of that back into liquidity. You're essentially growing your liquidity quite quickly, because if you have to rely just on the commissions themselves, then it's going to take a long time for you to grow that liquidity. So that's one of the drawbacks. If you're actually trying to do it in a fairer way, ultimately you're going to have to get listed on a centralized exchange and look at services like market makers, human market makers, and participants on centralized exchanges.
Right. All right. Thank you, Dusko.
Yeah, sorry.
Yeah, sure, go on.
If I can. Dusko, can I ask you a question?
Sure.
Okay, so one of the ways, one train of thought is that the market makers, we pay for the market making, right?
Yes.
So what could be one of the metrics by which you would pay the market makers? Should it be the number of transactions or the price of the token, or should it be slippage, or it should be something else? What should that be in your view?
You mean on a centralized exchange, the market makers, how we should compensate them, or
no, not as how you can compensate them, but basically what I'm trying to figure out is that how are they measured?
So I think the measurement of good market making, in my view, is the overall volatility of the price that you see on a daily basis. Obviously, longer term, the price will have a curve, either one way or another way. But in any given day, if you have good market making, you're going to see generally a lower price volatility any given 24-hour period. And I think that's one of the best metrics to measure how effective a market maker is. Effective market making services remove that high volatility. If you don't have market makers, you're going to have much higher volatility. If you do have that, they'll iron out that curve essentially. So I think that's a key metric in my view.
Yeah. I think that's pretty sound, because some people, I think quite a few token issuers, they try to gauge them by their token price that they have now got, right?
Yes.
So then that becomes a kind of it's a fair practice, market manipulation, or
exactly. And I understand why projects do that. Obviously, one of the incentives, I guess, on getting on an exchange is market making services, but the project's hope is that that's obviously going to boost the price. You're going to get exposure to the platform investors, and then maybe market makers can also do something. But really, that's not the way it should work. The project team, there's a marketing component and there's a growth component, product component of a project. You yourself are responsible for making sure that the project is growing, and that's ultimately going to impact the price. The market maker and the exchange is not there to influence your price. It's there to provide liquidity, to enable your traders to buy and sell at reasonable ranges. And that's the definition, in my view. The project.
Very great point, very good point, because I think you have that wealth of knowledge, but mostly sometimes we come across founders who do not have that experience, and they
don't have a finance background.
Yes, they always sort of blame the exchange for their price, right?
Yeah, exactly. And that's exactly right. And as I said, I understand, because the financial incentives are there to kind of try to think, okay, if I list on a centralized exchange, this is going to go through the roof. It will go through the roof if you do the work. If you don't do the work, nothing's going to happen. The exchange is not there to ensure that your price goes up. The exchange is there to ensure that you have access to market making, your price volatility gets lower, you have access to potentially other investors. They will help you market, but the dev team, the project team, is responsible for continuously growing the project.
Absolutely. Bang on the point. Just thanks for sharing. As a project owner, founder, I think it's very important for other founders to understand this concept,
Yes,
So
definitely. And I think there can be a lot of blame on obviously on exchanges, and I think it's unfair to a certain
there is, but it's good to coming from you. So Jasko, sit tight. We're going to continue our
Sure.
session. We're going to cover a few other topics, and
I'll
Meenu
be
is going to be
listening in.
covering that soon.
Well done,
So
guys. Very educational. I love the way
Thank
you're
you.
discussing, especially
I
you.
just wanted to add when you're talking about the token price, because
Yes.
I had done a little bit of series on my podcast on this particular one, and I wanted to do a little bit more further details. Like,
Yeah.
one is everybody talks about the value of your token, the price of your token, right?
Yes.
Now
Yes.
people talk about market making, X, Y, Z, and so forth. But then the thing is also, I mean, apart from the crypto tokens, I'm talking about the utility tokens. Now,
Yes.
in the utility token, apart from the speculative value which can come, the one thing is that how interesting your project is. But
Exactly.
then your token will not directly reflect your project gains. It
Yes.
takes only a percentage of your project thing. And how do you increase that percentage of your project gains to reflect into your token price? That itself, I think, is a very detailed amount of study involved in that.
Yeah, I mean that's a very astute point that you just made, and a lot
Yeah.
of tokens focus on price. I specifically, when I
yeah,
talk with my groups, I try to get them away from focusing on the price because everything depends on your roadmap, how well the team is executing, are they falling behind, and that's what people need to pay attention to, not
Hmm.
necessarily just the price, because
Hmm.
there's a lot of tokens out there with
Hmm.
no utility behind them
Hmm.
that do very, very well for a certain portion of time.
Hmm.
And then essentially that's game over from there because there's nothing behind it. There's no delivery. It's all about product and delivering on your concepts, on your roadmap, on your milestones, what you've said. That's what people need to pay attention to,
Hmm.
not
Yeah.
just the price.
Well said.
That's a very good point, you know,
Thank you. Thanks.
thank you.
among many.
So,
Thank you very much.
Thanks, Ashley.
we're gonna continue. So
Sure,
Dasko, be there. We're
I
gonna
will
bring you
do.
back front stage as well.
No.
So yeah. So let's
Okay.
just continue
So,
with our
yeah. So let's start with, we covered the liquidity mining. Let's start with the next slide, which has got liquidity token in it.
yeah
Yeah.
this one.
Yeah, I think so. Yeah. LP tokens. Yeah.
Yeah.
So, this particular one is with something called an LP token. Now, what happens is, as I said, the liquidity pool, it's a collection of your funds and it has an equal value of the token pair. I'll keep reiterating this particular point.
Yes.
Okay.
Yes. Equal value.
So what happens is that the liquidity provider, he puts in his token pair into the pool, the liquidity pool. Sorry. And then the pool generates a token at that time, and it generates a token which is called liquidity pool token or a liquidity token or a pool token. You take your pick. For my slides, I have kept it as LP token,
Yeah.
liquidity pool token. Okay. So what happens is that the pool generates this LP token and gives it to the provider. Okay. Now this LP token is basically it tells you what is your share in what is the share of your assets in the liquidity pool. Okay. So
Yeah.
10% share, for example, what I was talking about.
Yeah.
Or if you could also say that it is a mathematical proof of the funds that you have put, of the depositor, that the funds that the depositor has put into the pool. So
Mhm.
that's your LP token.
Right.
Now, on an Ethereum blockchain, for example, this token, we're talking about LP tokens being generic tokens.
Right.
So on an Ethereum blockchain, for example, this LP token could be an ERC20 token.
Yeah.
Okay.
Yeah.
So just keep that in mind when we talk about a little bit later.
Right.
Now, what happens is that this, I keep referring to my notes so that I cover everything, I don't miss
Yeah.
out anything.
That's okay.
So, what do you do with this LP token? Now that the provider, the depositor has got access, has got this LP token, what does he do with that? So, one is that he can redeem this LP token for his share of the pool at any time he wants, right?
Yeah.
So, that one which we saw with Anna. So,
Yeah.
that is the redemption. So, what he redeems is his share percentage at the value of the pool at the time of his redemption.
Yeah.
Okay, so
Yeah.
whatever is the value of your ether, DAI, or whatever is your token pair,
Yeah.
whatever is the value, he redeems it at that time. Okay.
Yeah.
The second one is that the person, the depositor, can use that liquidity provider token, the LP token, on the
Mhm.
native blockchain where
Right.
this is being used,
Yeah.
operated. Okay.
Okay. Yeah.
And then there is a third one because it is a generic token. You can use it, the provider, the depositor can deploy that on the other DeFi protocols,
Mhm.
which means that the depositor can put it into the liquidity pool of another protocol and then another protocol and then another protocol,
Right.
wherever that LP token can be used. So you see that the same LP token now can be used in multiple ways.
Yeah.
Okay. Now, what happens is that when this LP token, it gives the AMM platforms the non-custodial feature. Because now this LP token is solely in the hands, in the control of the liquidity provider.
Yeah.
There is no centralized entity which holds it.
No. Yeah.
So this kind of a decentralized thing, the non-custodial feature is very key to the AMMs, the automated market
Right.
makers.
Like this. Yeah.
Okay. So
Yeah.
that's how these LP tokens are helping. Then you say that the LP tokens, they kind of help you to gain more on your funds, the liquidity funds that you have put in. But more than that, they also help to improve your crypto liquidity.
Right.
Okay. Because what happens is it opens up an indirect form of staking. A
Yeah.
staking where you do not have to actually deposit tokens, you just have to prove that you own the tokens. So that LP token, remember I said it's a mathematical proof that you
Yeah.
have deposited tokens into the liquidity pool. So you can use this LP token now to improve the overall crypto liquidity.
Right.
Okay.
Yeah.
So, and this process of deploying your LP token from one platform to another, which like it can be transferred, it could be exchanged, it could be staked in different pools, etc. This process by which you are kind of deploying it across different platforms, different liquidity pools, or whatever the governance thing, this is called your yield farming because it is
Fun.
increasing the yield, the more return on your funds, on your assets.
Yeah.
Okay.
Yeah.
So in the next slide, yeah,
Yeah.
please.
The next slide.
In the next slide, I just have given an example of how yield farming and the LP token happens together.
Yeah.
How do they work together? Okay.
Yeah.
So what happens in this is that your liquidity provider, the depositor gives you deposits the token pair into the decentralized finance protocol, into the liquidity pool of that DeFi.
Yeah.
Okay. And for depositing that fund, the token pair into the pool, he will earn the interest and the trading fees. That's what we mentioned in the liquidity mining.
Yeah. Yeah.
Okay.
Yeah.
DeFi generates an LP token and gives it to the depositor.
Yeah.
Correct?
Yep.
Now, the liquidity provider, what he does is he takes this LP token, which he has been given, and he
Mhm.
stakes it into the DeFi staking pool.
Right.
And in return, he gets the DeFi governance token. And on that governance token, he will earn some farming yield.
Right.
Okay.
Yeah.
So this way, with the same amount of liquidity, he has earned on one side the interest and the fees.
Yeah.
And on
Staking.
the other side, he's getting the farming yield.
Yes.
So
Wow.
that's
So,
one of the ways by which you see that yield farming and the LP tokens, they work together.
yeah. So the DeFi staking pool and the DeFi governance token yields from
The
both
staking
sides.
pool and the normal liquidity pool through
Okay.
which your trades happen.
Right. Yeah. Yeah. Of course. Yeah.
Yeah, liquidity pool is the smart contract, and the trades would occur through that, right? In the
Yeah.
DeFi.
So next
So,
slide.
sorry.
Do I move to the next slide?
Yeah, please. Thank you. So that is about a few avenues by which you can make your liquidity work harder.
Yeah.
But I would just like to end with one concept,
Mm-hmm.
which is called a rug pull and
Hmm.
locked liquidity to do with
Yeah.
that. I think I had just very briefly mentioned about this concept, but did not explain it fully when one of the your guest speakers, token holders, was there on the thing. But let me just explain it a little bit detail.
Okay.
So what happens is that Now you have this liquidity providers who are putting in their liquidity into the pool, and you need this liquidity. Now, let's say somebody has put in a lot of liquidity into the pool, okay, or in any, he has provided a lot of liquidity for the tokens. What if one day this guy, this depositor, just removes all his liquidity and disappears? When that happens, people are left holding a token for which they have absolutely no avenue to sell because the
Yeah.
liquidity has dried up.
Yeah.
So, how that happens is, let's say you have a rogue token issuer,
Yeah.
and this guy, he creates a token A, hypothetically, okay, everything.
Yeah. Yeah. Sure.
So, he creates a new token called token A. And what he does is he pairs it with a very healthy and a very established token, let's say Ether.
Ether.
Okay, again for illustrative purpose.
Yeah. Yeah. Sure.
So he takes a token A, the scam token, he creates this token, pairs it with a healthy token, and he kind of provides a lot of liquidity for this token pair, that is token A and Ether. He puts a lot of liquidity for that. And he also promotes this token A, hypes it up, and provides a lot of marketing and everything to excite people, potential buyers, to come and buy this token A. Okay. So when a lot of publicity has been done, a lot of excitement is there around his token, what would the buyers do? They would, in the liquidity pool, they would buy his token A, and they would have to put in an equivalent amount of the healthy token, the Ether in this case,
Yeah.
right? So what happens is, this pool, you are getting less and less of your token A and
Scammy
more of
token.
the healthy token. So one day when this rogue trader, a rogue token issuer decides, I have enough of this established healthy token quantity in the pool, he takes away his liquidity.
Disappears.
And the poor buyers who have already bought a token A, they don't have any place to sell that token, right? So because the liquidity has dried up and the exchanges do not have the buyers for this token A now. So this kind of a process, this concept, or this thing is called rug pull. Okay, and to address this, to mitigate or to address this concept of rug pull, a concept of locked liquidity was created. So, in which what happens is that the liquidity, which is provided by the guys, by depositors, your liquidity gets locked by a time bound smart contract, which
Right.
means that within the time frame, you cannot move, redeem, do anything with your LP tokens or with your
Yeah.
tokens in that sense. So that instills some kind of a confidence into the token
In,
buyers,
yeah.
potential token buyers, that hey, this token is there for keeps or for
Yeah.
some time.
Yeah. Yeah.
So that is what I wanted to touch upon as
So I
run
think,
with the lock liquidity.
Meenu, this is a very real life scenario that you've hypothetically explained, but we do encounter such tokens.
Hmm, 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 hmm,
So it's not hypothetical. This is for real. But that's a very good point that
hmm,
exchanges should be putting checks and balances in place, like locked liquidity, to
hmm,
safeguard investors' money. So I'm
hmm,
going to
hmm.
stop the screen now and bring back Dusko online. Dusko, would you like to share something, some of your insights on this?
Yeah, so I mean, I think fundamentally I agree with the points that have been raised. It's very, very common, unfortunately, in this space. There is a lot of nefarious people and nefarious intentions, and it makes me sad. And that's part of the reason why we started this project, is because there is a lot of people that are still new to this space that are trying to get in and dip their feet in, and they're getting unfortunately exposed to a lot of people that have bad intentions. And so I think it's important for people. I mean, it's great what you're doing here. It's very educational for people. I think it's very important for exchanges to vet projects, to ensure that they are listing projects that are legitimate with legitimate intentions. Locked liquidity is very important. I think it's one of the ways that investors have an assurance. It's not a perfect assurance because there's ways to get around that. But locked liquidity is certainly one of the ways that projects can initially provide that legitimacy to the project. We have, for example, locked our tokens for 12 months, and we plan to lock them after that expiry again. for another 12 months, and as long as it takes, essentially. But that's one component. Obviously, another component I think that's really important is that the members of the project team are known. There's a lot of people that want to remain anonymous, and that's a red flag generally. Not all the time. Not all the time. Obviously, Bitcoin is. Bitcoin is one of the first, the first token, and it's still an anonymous founder. We don't know who did that, and it's community owned, and it's fully legitimate, as we know. But generally, it's a good sign when a project team, has their social media profiles online. You can see the background, you can see what they're, where they come from, and you can kind of gauge what their intentions are going to be like. Locked liquidity, as you mentioned, that is another one, and ensuring that effectively the dev tokens that are assigned to the dev team or for marketing, that also there's no hidden wallets, that there's no other methods to pull out liquidity, because even if your liquidity is a liquidity provider but have a whole bunch of native tokens sitting outside of that locked liquidity, you can easily just dump that on the holders, and we see that happening all the time as well. And also it's important to look at the contract. Our contract, smart contract, is very simple for a specific reason. If you look at a lot of these reflections tokens, they can be quite complicated, and it's hard to work out what exactly is going on with each transaction. And there could be hidden wallets, there could be hidden reflections in there. And so it's important for people and that's one of audits is another way, effectively. If you have an audit from a reputable provider, that's another positive thing that a project can do to ensure that they give investors as much confidence as possible. So there's a whole series of things that I think people need to look out for. And the best way to do that is watch podcasts like this and others and educate yourself and read a lot.
Yeah. Also, I think Dusko, because initially there were just a few tokens, but then as the popularity grew and people somehow say, okay, fine, this looks like good money or whatever it is.
Yes.
And every Tom, Dick, and Harry is creating their own token, or you see this in the NFT space. So as the thing is getting into a jungle space, you need a little bit more of, and everybody finds some different ways of getting around the stuff. And so you need all that education, or you need some regulatory stuff, which has to go in parallel with this growth. But I think it is the same for any evolving technology.
I fundamentally agree with you. I think that as we go, and I think we've made great leaps and bounds. And I think if you look at the beginnings of the previous booms that we had in crypto, with initial coin offerings, and there's a lot more shady things going on. So I think we're making headway, and I fundamentally agree with you. Any new emerging industry is going to have these kind of problems, but they will be fixed as time goes on.
Yeah.
Absolutely.
Yeah.
Great. Thank you so much, Jasko, for chipping in. I really appreciate your, sort of being very sporty about it. I just asked Jasko, is it okay? He said, yes, I'm going to be okay. I was just yesterday we had a chat, and so we would like to have tokens like Lunarland. I mean, where the CEO himself understands the concept so clearly. It's easy to work with such projects. Where people are blaming exchanges for their price changes.
Yeah, definitely. Yeah. Thank you very much for having me on. It's been a pleasure. And
thanks for your share, Dusko. Thanks a lot.
And you too, Meenu. I found it very insightful. Thank you very much.
Thank you.
And we look forward to work with you soon, Dusko.
Yeah, hopefully we'll have a deal soon, and we'll be on the token exchange.
Perfect. Thank you so much.
Thank you very much, guys.
Thank you. Bye.
Bye.
Perfect, Meenu. So we are back to us now.
Interesting and exciting. Good.
So it's like when you hear these real life experiences from owners of the tokens, it's always they are the validators, I would say.
Exactly.
So it's always good to have these people when you are discussing a topic like this. It's actually very technical for me, but thank you so much for simplifying it, Meenu. And I really like the way you explain it with examples. So I hope the viewers are also, like Dusko said, he found it very educational. But I hope the viewers are also I see a lot of comments, but unfortunately I cannot take those comments right now. It's too many of them. We can probably I can probably sort of take a summary out of these questions, and probably we can have another session where we can discuss the questions. So again, Meenu, last thoughts. We are a little over time today, but it's okay. So last thoughts before we wrap up the show, and what's in for next episode.
Okay, so we have actually shared quite a bit here. So, yeah, a little bit of your technical things come into the picture, but I guess when one is trying to understand the nuances, one needs to just dip the toes into the hot water a little bit, right? So I
Yes.
think that's necessary. But I do hope it was not too geeky or something like that. It was, yeah,
No, no, it's fine. It's fine. It was
thank
fine.
you.
We can. If people have questions, I see people because our audience are people from the industry. They're mostly
Hmm.
from the crypto industry. They are traders. They are owners, so they understand these concepts, right? As Dasco said, he's on Pancake Swap now, but his natural progression would be moving into a centralized exchange like La Token. So these people, as in like Dasco, they understand the ins and outs. So it's very important.
Yeah.
They do understand this concept. So thank you so much for explaining it so nicely that it also I'm also because there are some technical bits, but I get it now. Thank you so much.
Yeah, and also for people like who would like to get back or revert to some other details or specifics, they can go down to my Blockchain Hustle podcast.
Sure.
And because quite a few things that I am sharing here on this platform are also shared on my podcast. It's
Yeah.
just structured in a different way and so forth because it caters to the different audience. But yeah, so as far as the next episode, what I had in mind, Sunny, is to go to the CEX, the centralized exchange, and the decentralized exchange.
Right.
And maybe if you can get somebody to illustrate further, that would be great.
Yeah.
And later, I had in mind, I don't know when I'm going to put that, but something on the slippage,
Yeah.
because slippage comes out very often in our discussions.
Yes.
And later on, and I need some time to work out a complete structure for that, I would be just what I had mentioned to Dusko here. I would talk about the how does your token get the value?
Right.
And so there's something called a velocity problem, and how do you address that and stuff like that. But basically, all around the token price. So I
Yes.
think that would also be a very relevant, pertinent one.
Very
So we can
relevant.
follow that up. So these are a few things in the pipeline just to keep the guys interested.
Yes, very relevant token price. We're going to touch that because I'll tell you why when we come to
Yeah.
that topic. I'll tell you why. So yeah, thank you so much, Meenu, again for your time today. And let's just wrap up the show. A little bit time. I have another show in 30 minutes. So thank you
Okay.
so much.
Thank you, Sunny. And thank you, viewers, for listening in. Thank you for watching.
Okay, great. So I'll
Cheers.
be sorry. I just want to say something. Uh, I'm back again in 30 minutes at 7 p.m. Singapore. We're going to talk about, we're going to discuss about why VCs, venture capitalists, are now moving into crypto space. So please stay tuned and tune in to hear from our speakers who are VCs or work with investors in the space to tell you why VCs have suddenly started moving into the crypto space. Take care and thank you again, Meenu, and see you next Wednesday. Bye. Bye.
Thank you. Bye bye.